This is Viewpoints by Hennessy, a podcast featuring the latest thinking from the team at Hennessy Funds. My name is Jay Coulter. Joining me for this episode is Ben Cook. Ben is the manager of the Hennessy Energy Transition Fund and the Hennessy Midstream Fund. Ben, let's get right to it. You were recently quoted in a Wall Street Journal article saying oil price volatility is inescapable as an investment driver of performance. So what specifically should investors pay attention to as it relates to oil prices?
Yeah, Jay, thanks for having me. That's a great question. Oil prices have a direct impact on the revenues and cash flows that are generated by much of the companies in our investable universe. In order to navigate that volatility and capture the upside, minimize the downside, we like to look at three things. And I think those are very relevant for investors. One, we look for the lowest cost producers. Those generally have more resiliency in a volatile commodity environment. We're also looking for companies with balance sheets that have a visible path to improvement, as lower debt generally affords these companies with the benefits of, again, resiliency amidst commodity volatility. And of course, finally, we're looking for companies that have management teams that have demonstrated success in navigating both good times and bad. If you can combine all those three elements, typically you can do quite well through the cycle and the volatility that comes with it.
So, Ben, as you look out over the next 6 to 12 months, what do you expect from OPEC Plus?
Yeah, we obviously focus on OPEC very closely, but what I would tell you is that while we listen to what OPEC says, we follow very closely what they do, and over the next 6 to 12 months, what we will be looking for is follow through on the unilateral cuts that they announced in June for the month of July, and then extended into August. So we'll be looking for follow through on that. We'll also be looking for the extension of those cuts, the follow through by the Quota Alliance members. The extension of cuts have been extended into 2024, the year end 2024. So we'll be looking for participation across the broader OPEC Quota Alliance. And then finally, on a month-to-month basis, we look for proactive commentary by OPEC to stand ready to manage price stability. So far, they've done a great job, and there's no reason to think they won't. But we want to watch their comments very carefully.
So, Ben, how do you think the U.S. should approach refilling the SPR?
Yeah, that's a great question. So, I think as a matter of context, you look back, the SPR typically has been used as a means to manage volatility in times of disruption and dislocation as a means to ensure national security. More recently, it's been used to blunt price spikes. Nevertheless, it's important that we do refill the SPR. And I think recent comments from the Biden administration and the Department of Energy suggest that we will see some repurchases into the SPR this fall. Now, what we've heard is that the SPR refill will take place at prices below $67 to $72 per barrel. And that would be great given the sales took place at much higher prices. But the reality is that volatility could present challenges to refilling the SPR. And so our approach would be one of dollar cost averaging, making regular purchases of dollar amounts over periods of time, which allow for the avoidance of market timing. We think that plan would avoid the risk of hoping for price weakness that may just not come.
So, Ben, when you look out over the next 5 to 10 years, how do you feel this green energy movement is going to impact oil prices?
Yeah, when we think about the green energy movement, or the energy transition, as we like to refer to it, we often think in context of the primary fuel mix, and that is made up of not only oil, but natural gas, coal, nuclear, and renewables. And amidst that primary fuel mix and the transition that's underway, we see renewables and natural gas growing dramatically over the next 10 years. And that growth will come at the expense of the decline in coal and some impact to oil and nuclear. But the reality is that oil growth will occur over the next 10 years. And, if we look at some of the projections from the major forecasting agencies, including the IEA, in June, they put out their short-term or medium-term outlook. They expect oil demand to grow by about 5% between now and the end of the decade. decade. That's going from about 100 million barrels a day to 105 million barrels a day. And that's even with increasing penetration rates by electric vehicles. And the reason why we're seeing growth is that the transition, as it's underway, we'll actually see a movement more towards using oil as a feedstock for the petrochemical industry as opposed to a transportation fuel. So as the global economy grows and the need for consumer products and plastics, et cetera, grows, oil will be used principally as a feedstock as opposed to gasoline. Now, gasoline demand will likely fall by about 500,000 barrels, but overall, the broader crude complex, the demand for that crude will grow by about 5% or 5 million barrels over the next 10 years.
So Ben, let's pivot and talk about the Hennessy Midstream Fund. And first, at a high level, why should investors be interested in the midstream space?
Yeah, I think there are a couple reasons. I think first we have to acknowledge, though, that midstream companies, whether they're structured as MLPs or C Corps, they are income oriented, meaning they pass through or pay out a significant amount of their income to shareholders in the form of distributions or dividends. And that income stream is obviously very attractive. On a relative yield basis, midstream companies are paying out yields now that are comparatively attractive relative to REITs and other fixed income securities at a level that screens attractively to us. The second part I think that's important to point out is that many midstream companies pay out distributions that are underpinned by long-term contracts that do include price escalators, meaning that if inflationary pressures actually manifest and they push pricing higher in the energy sector, the pricing escalators allow the companies to increase their cash flow and again pass that on to investors. So in a sense, that provides some inflation protection. Thirdly, I think we as a country, the U.S. is enjoying a significant growth in its role as an exporter to the world across the hydrocarbon spectrum, crude oil, liquids, and natural gas. The midstream sector plays a significant role in facilitating the transport and storage, et cetera, to grow those export volumes. And midstream companies can provide a way to play that particular theme. I think the other thing to point out is that as an income-oriented equity, the midstream companies provide diversification benefits to a broader portfolio, and so you could reduce your overall risk while contributing to return. And finally, valuation is very good, screens very attractively at the current time relative to historical standards. So again, for a variety of reasons, we think midstream equities make sense for a portfolio.
So let's talk about your fund and the process. What is the investment process for the Hennessy Midstream Fund?
Yeah, that's a great question. We have been employing a very well-defined 5-step process since the fund's inception. It is the cornerstone of our investing activity. And, just to give you an example, I'll run through this 5 steps very quickly. Firstly, we source ideas by developing major themes, which we think will drive relative midstream asset performance. And, we can use as an example the idea of growing energy exports from the U.S. as a key theme. And we just talked about the role that the U.S. plays in delivering increasing amounts of hydrocarbons to the world. Now, the next step within that theme is to identify the companies that are best positioned to benefit from those major tailwinds. So we're going to look for companies that operate assets that facilitate the transport of hydrocarbons to export facilities, and then ultimately beyond the shores of the U.S. To deliver those molecules to other countries, consumers around the world. Within the subset of companies that are going to benefit from that theme, the third step of the process that we employ is a valuation process. We look beneath the surface of the company to scrutinize the assets. We model the operating and financial results of the companies. And based on a relative valuation score, what we'll look at is the relative risk reward attractiveness, if you will, of each of the securities, again, in that subset, ultimately, which takes us to the next step is implementing the investment ideas. We're going to scale and position the companies in our portfolio based on our conviction level. And again, that goes back to the valuation case. And then finally, we exit or repeat the process as it may be. If a company achieves its certain targeted level rate of return or the risk reward balance is no longer favorable, we'll exit that particular company. Or by contrast, if a company has not achieved its rate of return, we'll look at the reasons for that or look at alternatives for the portfolio and scale those ideas accordingly. So we're constantly high grading the portfolio with the best ideas. Again, it's a repeatable process that is scalable, and it's worked very well for us since fund's inception.
Let's talk about some of the holdings in your portfolio today. So your
Sure.
largest holding is Energy Transfer. What is the investment case for that holding?
Sure. Energy Transfer is one of the U.S.'s largest integrated midstream companies. They possess an asset footprint that essentially links the source of production with the end user across multiple categories of hydrocarbons. That company stands out as attractive to us given its significant footprint in the Permian Basin. The Permian Basin in West Texas and eastern New Mexico happens to be the growth engine for crude oil production, liquids, and for natural gas here in the U.S. And many of those volumes are actually being transported to the Gulf Coast or to Mexico for export. The company screens attractively in the sense it has above average yield. And as I mentioned, we like companies with a visible path to debt reduction, and they are embarking on a debt reduction process. The company has been adept at hiking distributions as well as repurchasing units, and we think that'll continue to going forward. So we like the asset mix, we like the yield on Energy Transfer, and we like the valuation at the current point in time.
So one of your holdings, Enterprise Products Partners, you've held for 9 years. What is the investment case for that today?
Yeah, good question. So Enterprise Products. So Enterprise Products is a blue chip, highest quality midstream company in the midstream space today. Like Energy Transfer, they possess an integrated linkage of assets connecting the source of production across the hydrocarbon spectrum, all categories of hydrocarbons, to the end user, which allows them the opportunity to generate revenues as they handle or touch those volumes as they make their way through the value chain. As an incumbent in many of the industry's main processing centers, they have the ability to add new capacity and develop new projects, which give them the ability to grow very efficiently. And the company has had a sterling reputation in terms of growing its distribution. Valuation also screens attractively to us now, and we think it should make up really anybody's midstream portfolio. Very high quality company.
So one last question, but what is the investment case for NextEra in the portfolio?
Yeah, NextEra is a name that we own for its exposure to the renewable growth trend. As I mentioned, the fastest growing category in the primary fuel mix is renewables, and it will outpace the other categories in the hydrocarbon and nuclear spaces. So we like the growth potential there. NextEra is a U.S.-based utility. It has the largest development portfolio of any utility in our investable universe. The company focuses on solar and wind, and more recently on hydrogen. And we think the recent passage of the Inflation Reduction Act has improved the visibility for investment tax credits, which will have a direct benefit to many of the projects that are being pursued by NextEra. The NextEra has an attractive dividend yield, and we see earnings growing there and dividends growing quite nicely over the next several years. It's one of our key holdings.
Ben, thanks for coming on Viewpoints by Hennessy. Viewers, to learn more about the Hennessy Midstream Fund, please visit hennessyfunds.com.